Just a quick note before we dive in. Even if AI helped for some part of this video, however, you can trust that all the information provided is dependable. The insights are drawn from the most credible books, authors, and experts, focusing specifically on the principles of growing rich. Because of this carefully curated knowledge, this content is expertly crafted. Society treats homeownership as an automatic ticket to wealth and shames renters for throwing money away. This cultural pressure ignores the massive financial shift that has occurred over the last few decades. This chart contrasts the historical baseline of buying a home against what the market demands today. The old path provided stability with low effort. Modern reality demands extreme risk, leverage, and hidden costs. Taking out a mortgage today is your most concentrated allocation of capital. This isn't an argument against buying a house. It's a process for stripping away real estate marketing to identify the true opportunity costs. By the end of this video, you will have a 5-point framework to decide if buying actually matches your life. Decades of strategic, well-funded marketing created the image of the perfect single-family home. Organizations like the National Association of Realtors, who recently faced a billion-dollar judgment, spent millions to cement this specific version of success in our minds. The math used to support this narrative. A house once cost roughly 2.5 times a buyer's annual income. With 20% down, total housing costs stayed comfortably under 30% of gross income. Today, those rules are broken. Buyers routinely stretch for homes costing 5 to 10 times their salary, while putting down as little as 3%. Relying on these outdated cultural rules leaves you vulnerable. Following a 50-year-old formula in a changed economy leads to severe financial overextension. We must first address the assumption that real estate prices constantly go up. Real estate transactions are obscure. Builders and sellers often use backdoor concessions, like interest rate buydowns, to avoid lowering the official listing price. This hides real price declines from the public record. There is also a belief that a home's value doubling over a decade guarantees a profit. This perspective ignores the reality of phantom costs. Phantom costs are unrecoverable expenses: property taxes, insurance, closing fees, and inevitable maintenance shocks like a roof replacement or plumbing failure. This data visualization plots a 6% average historical property return against the historical returns of the S&P 500. This gap represents your opportunity cost, the compound growth you sacrifice by locking your cash in a physical structure instead of a liquid market. These metrics are vetted. Yale economist Robert Shiller tracked home prices for a century, proving that real estate returns for individual investors are often lower than people assume. Factoring in phantom costs and lost market gains often results in a net negative cash position, even if you sell the house for more than you paid. Many people view real estate leverage as a guaranteed way to multiply wealth. Leverage works both ways. Logic: you are paying a full dollar of interest to the bank to save a dime in taxes. It is a net loss of 90 cents on every dollar spent. Using extreme leverage and complex tax breaks without mastering the math creates false security while increasing your vulnerability. In cities with a high cost of living, there is a powerful alternative: rent an equivalent property and invest the difference. Calculate the true monthly cost of owning, including taxes and maintenance. Compare that to the cost of renting the same unit. In many markets, owning costs twice as much per month. If you redirect those thousands of extra dollars into liquid S&P 500 index funds, you can often build more wealth than a homeowner. Homeowners often concentrate nearly all their net worth into one building, exposing themselves to catastrophic risks from local market shifts or structural issues. Renting preserves your geographic agility and allows you to capture compound growth without the concentration risk of a single property. To succeed, you must treat a house as a costly lifestyle purchase first and an investment second. This decision tree identifies the correct outcome. Checkpoint 1. Can you commit to living here 10 years to amortize upfront costs? Checkpoint 2. Is housing under 28% of gross income? Checkpoint 3. Have you saved 20% down to shield against negative equity? Passing these 3 checkpoints indicates you have the capital to absorb the shocks of ownership without destroying your portfolio. Checkpoint 4. Do you have the psychological tolerance to watch your home's value fluctuate downward? You must accept the reality of negative equity. The house is a long-term shelter, not a get-rich-quick scheme. Checkpoint 5. Do you have a personal desire for the labor of maintaining a home? This desire should exist separate from societal guilt or pressure. If you do not pass this filter, renting is a sophisticated strategy for preserving liquidity. If you pass all 5 checks, you are financially clear to buy the house and enjoy the lifestyle without guilt. If you find this valuable, please make sure to follow and subscribe to our YouTube channel, Raise. Success isn't defined by owning a mortgage. It is defined by ignoring the propaganda and running the math to match your life goals.